Welcome to my channel. I'm the Covered Call guy, and this is my journey to creating a $120,000 per year passive income portfolio. I currently yield about $61,000 a year, just a little over $5,000 per month. Before we get started, legal disclaimer: all content presented in this video is for informational and educational purposes only and should not be considered financial advice. I am not a financial advisor, broker, or professional. The information provided is based on my personal opinion, experiences, and publicly available sources at the time of publication, and may not reflect current market conditions. Trading and investments involve substantial risk, including the potential loss of principal. You should always conduct your own research and consult a financial professional before making any investments or financial decisions. All views are my own, and I do not represent the opinions of any other party or organization. Again, I'm just some random idiot you found online, and I can be completely wrong. With that out the way, today's video was actually inspired by me just doom scrolling on my phone on YouTube, and I came across one of my favorite movies of all time, Margin Call, and I thought, why not use margin if the rates are in my favor to buy high yield stocks and invest the difference? Wouldn't that just be a money hack? Wouldn't that just be the easiest money? And I thought about it, and I was like, I'm sure a lot of people have thought about it too. I'm sure a lot of people have maybe tried it. If you're watching this video and you actually use margin and you have successfully made a lot of wealth from it and double, triple, quadruple your income, 5-6x your income, great. Maybe you can share some, comment on my video and tell us how have you done it, because at the moment, when I did my research, again, I'm using what is available now. I came to the conclusion, and at the end, I think you'll like, you appreciate my verdict, especially for those who are new in the income investing field and or more of the covered call area. Let's get started. Using margin on covered call ETF, a golden opportunity or a high yield trap? The seductive promise, right? We're all seduced by that, borrow at 8%, we have a 12% cover call yield, and we pocket the 4% spread. I was like, man, this is easy. This is like free money. Free money. But is it really? Right? So the ideal scenario in a perfect flat market, we're probably not going to get this ideal scenario under this current Trump administration, right? All it takes is one tweet or one post on social or on Truth Social, and your whole portfolio could blow up, right? For those that are on margin, leveraged, right? So we're talking about in the ideal scenario, in the perfect flat market, this would probably be where I would, okay, all right, I'll think about, using margin, right? Deposit $10,000 cash, borrow at 8% interest. I invest 20,000 in a high yielding covered call ETF yielding at least 12%. I would say that's my range. Profit, earn 2,400. I paid the 800 and I net 1,600. That will be the ideal easy money. I'll do it all day, every day. But there's a reason why a lot of people don't do this, and those who do really are taking that extreme risk. It's pretty much a gamble, right? So there's 4 points why this strategy fails. And number 1 is the margin call doom loop, right? The market drops 30%, right? Trump can literally tweet or post on social or on his Truth Social, and we're back at again with a trade war or something, right? Like something. He might deploy troops and he just declares war. On top of that, plus tariffs, whatever it is, right? So market drops 30%, your 20K now becomes 14K, right? your collateral vanishes, your equity 4K, um, well 14K value minus 10K loan, boom, gone. Have 4K left. And then third, when that happens, you get margin called, right? Broker demands cash or forces selling of shares, and losses lock in. You sell at the bottom, destroying your capital base. So for those who have never taken a financial course, right, this is a joke that gets passed around, right? The two L's, right? When you take leverage, what comes after? You get liquidated, right? So that's the joke, right? So you play with leverage, you're most likely gonna get liquidated. Not always, but for those who dabble in it, and those who never done margin or didn't do the research, or just see it from that outside perspective, be like, yo, this is free money. But it's really not, right? You're taking that chance where it could ultimately be what we see now, the scenario, risk 1, the margin called doom loop. All right, and then risk 2 is the capital NAV erosion. I'm using real data here. I believe I've entered it correctly. So let's just say when you bought TSLY with $100, you can see, right, since TSLY's inception in late 2022, the price of Tesla stock is over 90%. In that same period, right, TSLY's price NAV has collapsed by over 70%. Why? Tesla strategy sells all the upside while the actual underlying moons, and TSLY's NAV stay flat. But the Tesla shares crashes, TSL's NAV crashes with it, right? The result, the fund keeps the losses, sells the gains, and that's what we call a one-way ratchet. It destroys its capital base in real time. Risk 3, right? The net profit spread. Your entire profit depend on this spread, your ETF yield minus the margin rate. This spread is not stable. Margin rates are variable and often tied to the federal fund rate. When the Fed raises rate, your borrowing cost goes up and your profit shrinks or even goes negative. So then we ask, well, what in perfect scenario would it be ideal to use margin? So if the rates get cut, does it make it safer? Technically, yes. When the Fed make margin cheaper, which widen the spread, right? This only fixes one of the 4 risks, right? This only fixes risk 3. You still have risk 1, which is being margin called, risk 2, the NAV erosion, and then risk 4, which is the drop in yield, which is the next slide. Risk 4, the yield compression, right? I just put minus 50% in potential yield drop. Covered call ETF yield are not guaranteed, right? The yield is not a fixed rate. It is a projection based on last month's option premiums. Option premiums are set by market volatility, the fear gauge known as the VIX, right? So if you don't know what that is, if you follow the VIX, it does show you buying opportunities. I follow it myself. A high VIX of 30, premiums are expensive, and ETF might sell options for premiums that annualize to a 50% yield. Low VIX at 15, premiums are cheap. The exact same options might only sell for premiums that annualize to 25% yield, right? So this is a 50% drop in your potential income caused by a calm market, not a change in the fund. And that's what a lot of people don't understand about covered call ETFs too, is that the yield is what they're projecting, is what they're aiming for. It doesn't mean they will. The ETF spectrum from bad to worse on margin. So this is my collective. I put this list together based on how I would feel if I hold these stocks and I wanted to do, if I wanted to use margin. Right, so again, I just want to put it out there. I have nothing against yield max. It's just that yield max, it was just the best example I could find. I was trying to find other covered call ETFs, but yield max was just screaming pick me. And I would say these are the highest risk when you if you want to use margin to buy covered call ETFs, right? These are the NAV eroders, and you know it and the gamble, right? Yield Max uses single stock and it's synthetic. So in my opinion, you should never use margin, right? I would never even buy these stocks until I have built out a foundation, a core portfolio, and I've hit my goal. And then I would dabble in maybe picking. Not all yield max cover call ETFs are losers, right? I obviously there's a lot here that I would not choose. There are some yield max that perform very well. And then we have the 100% overwrite in index trackers. So these are the ones that completely cap off all upside. So I would stay, if I own these cover call ETFs, I would not use margin to increase my income. I would stay far away. So the single stocks and synthetic cover calls, and the cover calls that have 100% overwrite, which completely cap the upside. Now, the lower risk capital preservation focus cover call ETFs. Now, if I own these particular cover call ETFs and the margin rate, is looking ideal, right? We have about 2 more rate cut before the year ends, before 2025 ends. I have to double check on that, right? So if the Fed comes out and be like, instead of a 0.25, there's a 0.50 cut, and then before the year ends, another 0.50, right? And the margin on your brokerage is very, it gets lowered, and it's in a range where I'm very comfortable, and I hold these particular cover calls. I couldn't list them all. It was making my title go out of the slides, but there are a lot more. I had to remove a lot. I had probably like 15 or 20 in each: active management, out the money, and hybrid and tax advantage. I had like 15, 20 in each. I just had to remove it. But this is the cover call ETFs. If I held it, I would consider using margin to increase my income. Not all of them are traditional cover call funds. I believe these two are they don't always use cover calls. They also combine it using protective puts. I believe they use what they call a collar strategy. And basically what that is just a defensive option strategy. It's not exactly, it's a defensive option strategy used to protect against downside losses, but it limits the upside gains. So it's kind of like, it's a tug of war. Basically, I'm willing to go to the middle. I don't want to lose too much, but I won't also gain too much. And I believe, I think it's this one too. I forgot. Let me see. I'll double check. Or is it this one? Anyways, there's 3 of them. I know it's these two, and I think it's this one. They're not your traditional cover call ETFs, but I just have it in there because they're pretty great ETFs, and I would consider them. Okay, survivability. This is the whole point, right? You want to make sure you survive, right? So in that movie Margin Call, that the CEO just pretty much, we have to survive, and you have to do whatever it takes to survive, right? And again, this chart is just hypothetical risk return, likelihood of a margin call. Divo, right, is extremely low, but Divo's yield is about 5%, extremely low. All right, it's not low, it's great, but you would probably, I would probably never use margin on Divo unless margin is like literally near 0%, like 1%, because Divo give out what, maybe 5%. So I'm not really, there's really no like crazy upside to it. And then JEPI, I believe is 12%. No, it's 8%, 10%. It's also low. JEPI is pretty solid. I love JEPI. And then QYLD is obviously about 12, 13, 14, 15%. So it does 100% override calls, and it completely caps the upside. So it's high because it has shown NAV decay, and when it goes down like that, especially split second the market just turns, you're gonna get margin called. And then, of course, TSLY I used in my earlier slides. I wouldn't mean there's absolutely no point unless margin was like 1, 2, 3%. Then maybe I wouldn't even want to risk that. There'll be no point. I mean, there's so much other better covered call ETFs. So what does this mean for income, right? You cannot increase income if your account gets liquidated. Like I said, what comes after leverage? Liquidation. This chart shows the survivability of your margin strategy, and then we have the extreme risk, high risk, lower risk, right? Extreme risk, these funds are designed to lose NAV. They are taking time bomb for margin call. The risk of losing your entire principal is massive. High risk, QYLD, these funds are ratchet down and don't recover. A market crash or a correction will permanently impair the value, making a margin call very, very likely. And then the lower risk, Devo, JEPI. There's a few others I gotta put in there, but Devo and JEPI is one of the most stable. I love them. I love those two. These funds are designed to preserve capital. Their NAV is more stable, making them far less likely to trigger a margin call. The survivability is the only way a margin call strategy has a chance. So, of course, you have to determine, is the margin rate worth putting that type of leverage and buying a stock that could swing up or down, right? You want a stock to just not move or go up in a bull market. That would be nice too. And then the last slide, my verdict, right? Who is margin for? For a vast majority of investors, would I say use margin? Absolutely not. Why? The risk is catastrophic. Permanent loss from a margin call is not worth a small, unreliable spread. And again, I just want to put a disclaimer there because I don't want anybody to even enable margin until you have really done the research. Margin can be a very powerful tool, but it can also be a very dangerous tool, right? Margin is kind of you're flipping a coin, especially if you don't know what you're doing. Margin could absolutely destroy your portfolio. All right, so if you don't know what margin is is when you trade on margin, you're using a loan from your broker to make a trade. I should probably said that in the beginning, but right, leverage is the outcome. You're using this borrowed money so you can control a larger amount of asset, but as much as that amplify the result, right, you can also completely lose everything you own, hence margin call. We'll probably get into a next video about leverage ETFs, but today's is just about margin and using margin to increase your portfolio and your income. Steady and slow, that's the way to go. Steady and slow. All right, see you guys on the next video.